Hi, I'm Nina Easton with Fortune Magazine. Welcome to our one-on-one with Roger L. Martin. Roger L. Martin, my guest, is not one to let lazy thinking lie. That's what he's most known for through his books, through his consulting with companies, through his cutting-edge thinking on all sorts of areas in his life. Roger, before we go into the topic at hand, which is how to alter the rules of capitalism, I wanted to kind of, for people here who aren't familiar with your work, I wanted to give them a sense of who you are. And I want to do that by noting that you're the Dean of the Rotman School of Management at the University of Toronto. You came in there deciding that you didn't want to run a business school that just turned out jargon-spewing economic vandals. So you changed the way things worked there and the way that people thought. Can you fill us in on that?
Sure, and that is a wonderful economist quote. But I think that business schools, to too great an extent, have gotten very happy with and satisfied with teaching business students the way they always have for 100 years. And some of the results of that are not what anybody would have loved. Big financial crashes, increasing income inequality, and corporations not, in general, taking enough responsibility for anything outside making a dollar for their shareholders. And so I believe that most business people actually don't want to be, and most MBAs don't want to be jargon-spewing economic vandals. They actually aspire to something greater, and we need to teach them different ways thinking, a more designerly way of thinking, so that they can be more comfortable with being creative, more to think more integratively, to be able to think more broadly and holistically, and not be scared. I sometimes think that that MBAs get taught so narrowly that they're scared when anybody says, "Shouldn't you be thinking about the impact of this on the environment or on your community?" And they say, "Gee, I don't know how to think about that because nobody ever taught me." I think if we just teach that, that we can produce all sorts of MBAs who are absolutely terrific and hugely important to the world.
So you have a love affair with capitalism, as you said to me in our first conversation. I love capitalism, as we just heard from Prime Minister David Cameron saying somewhat the same thing. But it's a tarnished love affair. Give me a few sins of capitalism that you've cited.
Well, I think capitalism ever really intended to produce these sort of gigantic crashes that are so damaging to the average citizen of the country. The notion was it should be sort of self-correcting, but it hasn't appeared to be to too great an extent. I worry that capitalism, as it runs its course, seems to produce ever more income inequality. As long as the median income is rising, I'm not so terribly concerned about inequality. But of course, in North America, median incomes have not been rising over the last 20 years or so. So that I think of as a failure of capitalism, or at least capitalism not doing the best job possible.
So you have a new book out called Playing to Win, and hot off the presses. And before this, you had a book called Fixing the Game. One of the things that you dwell on is the ability of the players in the capitalist system to game the system. Talk about that. Well,
yeah, I see it. I see it particularly in the capital markets. But I mean, I think any game that you establish the rules of, folks start to game it. So when we give executives, for example, stock-based compensation, we think this is good. This is great. This will align the interests of management and shareholders. Isn't this a lovely thing? But then executives slowly but surely figure out that, actually they don't get more benefit out of their stock-based compensation by making their company perform better. They get it out of making people think that in the future their company will perform better. So if they go and raise the expectations about future performance, then they'll get a big payoff. But that's not how the rules of the game, if you will, if you want to call it a game, were set. the idea was they would work very hard on making sure their company really did well, and not spending their time hyping their stock on Wall Street, doing mergers that they shouldn't to give the appearance of growth, playing hanky-panky with accounting. But that's what we've seen, which is increasingly gaming the game of executive compensation. And it's created, I think, it's been a big player, a big factor behind the boom and bust cycles we've had of late.
And another case you cite is high-speed trading. Excuse me. Describe that.
Yeah, sure. I mean, we have a game going on now where high-speed traders are spending enormous amounts of money to get their trades to the server, the New York Stock Exchange server, milliseconds ahead of other people's. And I mean, to me, I find it amazing that New York Stock Exchange is cooperating with this. They put up a facility out in Mahwah, New Jersey, an hour outside Manhattan, with their trading their servers, their trading servers out there. But they built it big enough to lease space to high-speed traders, so they could co-locate their servers. If you paid New York Stock Exchange a big amount of money, you can co-locate your servers right there and get your trades to the NYSE servers that much faster. And I asked myself, seriously, really? That's how you want to play the game? You want to play the game as you're the stock market. You're supposed to be sort of a neutral player, and you're going to enable some traders to have an advantage over all other traders. When people started stock exchanges 100 years ago, that wasn't the way they thought the game was going to be played. They thought the game was going to be played, this is a great way to raise capital for new companies, not this is a way to create massive speculation and having people win or lose on the basis of getting their trade to the exchange a millisecond faster.
You know, and another aspect of this game that you're critical of is that great reward of capitalism, IPOs. Talk about that a bit, and you cite LinkedIn as an example.
Yeah, I'm quite amazed at the degree to which investors will invest in IPOs and pay gigantic multiples of earnings, 100 times earnings or even more, and not imagine that going public will create a different incentive structure than the company had before it went public. Right? So, and I've experienced this as an angel investor in companies. Before the company goes public, it can hire all sorts of people and give them stock options with a chance of going public and making a big killing. The minute they go public and the stock is valued at an incredible height, suddenly those stock options aren't for potential new employees are not all that great interest. And often the founders suddenly have more money than they've ever imagined having in their life. And the incentive to keep on working the way they've worked has changed. I just don't see in many IPOs like a LinkedIn, which, by the way, the IPO price there built in that it was assumed that they would grow in revenues and profits at a rate about 27 times as fast as Google did when it went public. Yeah. Maybe. But I don't know about you. I don't find LinkedIn interesting. Do I find it 27 times more compelling a business model than Google? Yeah. I don't think so. So it's all an expectations game. And again, people think that stock prices are somehow a reflection of the real company. They are not. Stock price is nothing but the accumulation of everybody's expectations of what they think will happen in the future.
So let's turn to your analogy, and which underlies what your theory is, which is you're going to look at the NFL as a model, and you talk about a market of expectations
yes.
versus market reality.
Yes.
How does that work?
Well, what I think is the NFL is a nice metaphor for business because there's a real game. Every Sunday, a whole bunch of teams go out on a real field for 60 real minutes and have real runs and real passes, score real field goals and real touchdowns, and there's a real winner and a real loser. And that's a very big game. It's a $10 billion game, the most sort of profitable sporting activity on the planet. But there's also an expectations game between Monday and Saturday. These people called bettors phone up their bookie in Vegas and imagine what's going to happen on Sunday, and on the basis of that, bet. And the bookies in Las Vegas establish a point spread. So they give points to the underdog. So if you bet on the underdog, let's say, I don't know what the Super Bowl line is. It's probably San Francisco by 5 points. And if you bet on Baltimore, they have to either win or lose by 5 points or less, and you win. And if you bet on the favorite, they've got to win by 5 points or more, or you lose the bet. So this point spread is the summation of all the expectations. Right? It's similar to business, right? There's a real market where companies build real factories and produce real products or services and make a real dollar at the end of the year. And then there's an expectations market, people looking at that and imagining what's going to happen in the future, and on the basis of that, a stock price is established and moves, just like the point spread moves during the week. Between now and the Super Bowl, it will move. So there's that parallel. But the interesting thing is, in the NFL, what NFL governance says is that if you're involved in the real game, you're a quarterback, you're a coach, you're a general manager, if you ever get involved in any way in the expectations game, you are banned from the sport for life. You're not slapped on the wrist, you're banned from the sport for life. So we got that situation. Versus business, where we say, if you're involved in the real game, you're a CEO, you're a board member, you must be involved in the expectations game. You must be heavily involved in the expectations game. If you're not, we won't allow you to be a CEO. Or if you're a board member and you don't have 5 times your annual board fees invested in the company, you get kicked off the board. So you ask, what's with the NFL? Why are they so uptight about this? Well, the reason is they don't want the quarterback kind of screwing up the real game in some way, manipulating the real game in order to make money in the expectations game.
So how do you get businesses back to the real game?
Well, one is
and that would mean focusing on customers and product and so on, and not on Wall Street.
Well, a few things. One is we have to really rethink executive compensation. So my work, which I talk about in Fixing the Game, demonstrates that ever since we started paying CEOs and other managers, but CEOs with stock-based compensation, returns to shareholders have fallen. The idea was they would rise because we have this great convergence of the interest and alignment of the interests. No, what's happened is that shareholder returns have gone down while CEO salaries have shot compensation, including stock options and other stock compensation, have shot through the roof. So one is we've just got to recognize that actually stock-based compensation is a bad idea, not a good idea. I personally would ban it entirely, just like the NFL. Just say no, you can't do that. You're either in the real game or the expectations game. You can't be in both. But if we're so in love with it, we can't let it go. I would make it not legal to have your stock-based compensation vest until after retirement.
I want to get back to the NFL analogy, but another gamer that you seem to have problems with are hedge funds. What would you do?
Well,
and how do they game the system?
Well, what they do is they're interested in volatility, and so hedge funds and CEOs now have great common interests, right? Which is in volatility. Like if you think about it, if you're a CEO, you come on to the company, and the stock is, let's say, at $50 of your company. You have a huge incentive, actually, to immediately say, oh, "It's a disaster. I thought it was better. Now that I've looked under the covers, it's just terrible, and I'm going to have to do a major restructuring." You get the stock down to $25, and then you work assiduously to get it back up to $50 over a couple of years. You get stock options at $25. You get it back up to $50. You make a killing, and the shareholder makes what? Nothing, right? Hedge funds love that, right? They absolutely love that because they make money on volatility. The worst thing for a hedge fund possible is for the stock to stay flat at $50. They'd love it to go to 25. They'll short it on the way down, and then go up to 50. They'll go long on the way up. And so they simply have an incentive to exploit and actually produce volatility. And I think more so than anybody would like to believe, I do believe that many of them act in concert to produce volatility, and the CEOs are happy to have that.
And what would you do about them?
Cut off their supply lines. This is like war. In war, the important thing to do is cut off the supply lines of your enemy, and their supply lines are pension funds, more so than any place else. It's not rich individuals, it's pension funds that they're giving them their big bucks. And let's just think about this. So you've got long-dated liabilities, right? 20, 30, 40, 50 years as a pension fund, and you're going to invest in a vehicle that is a 5-year vehicle where you're paying 2 and 20, so 2% of assets under management and 20% of the upside. The 2% is enough for the hedge fund managers to make a huge amount of money, and so they'll swing for the fences with your pensioners' money. So I would ban pension funds investing with any investment manager who charges both a fee for assets under management and a participation, a carry. One or the other.
Let's go back to your NFL analogy, because you like the way the NFL tweaks the rules regularly in order to level the playing field. Let's quickly talk about your passing analogy.
Sure.
Yes.
Well, this is what I like about the NFL. The NFL is all about the fan experience, and the fan experience requires that the teams be competitive and the offense not dominate the defense. And so when some clever coach, some innovator, comes up with a new offensive or defensive structure that ends up being too successful, the NFL tweaks the rules to bring offense and defense back into alignment. And the great example is Bill Walsh, the legendary San Francisco 49er coach who created the West Coast offense, which was an offensive system for the non-football junkies in the room, an offensive system that instead of having runs and long passes, had a bunch of short passes back to back to back to march down the field.
For your weak-armed quarterback.
Yes, that's right. That's exactly right. And it was monumentally successful. But then the NFL said, we can't have the offense dominate the defense because that'll make it less of a fun and interesting game for the fans. And so it allowed the defensive backs to chuck the wide receiver once within 5 yards of the line of scrimmage. I love it because it's such a little tweak, right? It does that you can't tackle them. You can't do it in 7 yards. You can't do it twice, once within 5 yards. And that brought the two back into more balance. And it's that kind of little tweak that we need to do. We don't need to do massive, humongous, this is going to solve all the problems of the world, Sarbanes-Oxley, Dodd-Frank kind of fixes. No, we just have to keep tweaking and tweaking and tweaking because there will be gamers. Right? And do I not like Bill Walsh? No, he's fantastic. But does that mean we can let Bill Walsh change the dynamics of football? Nope. We have to tweak it to make sure that football and the fan experience continues.
So you're very critical of Sarbanes-Oxley in the U.S., of course, and Dodd-Frank, 884 pages, for trying to solve everything. Yeah. And in the course of it, doing what?
Nothing useful. Like there's no utility that I can find whatsoever in Sarbanes-Oxley. Like if I go through the whole of it, and it's imposed gigantic, enormous costs.
Give an example of the cost.
Well, 404 certification, certifying that all of your processes are in control. I'm on the boards of two big publicly traded companies, and it's just tens of millions of dollars every year to make some bureaucrats very happy. If it actually did reduce risk, I would feel all cheery. But last time I checked, I believe that was done after the first big meltdown. And how long did it take to have a meltdown?
2008, yep.
It took about 3 or 4 years. So before Sarbanes-Oxley, it took us 70 years between meltdowns, right? And after Sarbanes-Oxley, it took us 7 years between meltdowns.
And Dodd-Frank, you expect that
7.
Could happen. Seven's what we're looking at before something happens.
That would be my guess, actually. Something on that order. Yeah.
And my problem is I keep saying to you with this whole theory, however, I'm in Washington.
Yes.
I know
I'm
politics.
sorry.
The
I'm
politics.
sorry,
I
Nina.
know. I'm intimately familiar with this world of Washington. Can you imagine coming down and tweaking rules on a regular basis with the lobbyists, the interests, whatever interests are in Capitol Hill, the fights? Every time you're tweaking rules, it's a bloodbath. How do you solve that?
Well, it is a good question. Nobody's ever asked me to solve Washington before, so that's it. I think we have to step back. In some sense, I think we're locked in Washington into a big fix mentality. And so, okay, now we're going to do the big think that's going to totally fix the capital markets. I think the moment you announce that, right, you know you're going to go into a big effort. This is like, again, having a big fixed army kind of war. The lobbyists get all sorts of time to get prepared to weigh into battle. And they know it's going to be a long battle, and so they can gear themselves up to battle, and the two parties go at each other because this is the one big chance we're going to do it. So I think a lot of what we have is a product of the mentality or the mindset, which is Sarbanes-Oxley is going to fix it all, or Dodd-Frank is going to fix it all, and I think if you just change the mentality to say there is no fix to it all, there isn't. We live in an imperfect world. There is no utopia. And what we've got to do is have intelligent people just try to do little tweaks that you can undo if they turn out to be problematic.
And isn't this what the agencies, let's take it out of the purview of Congress, but
Yes.
agencies are supposed to be tweaking rules, although they have to do it within the context of legislation. So our agencies aren't doing that. And secondly, what do we need an NFL commissioner of finance in Washington?
You mean, there's a side of me that says that wouldn't be a bad idea. That if you had somebody who was kind of responsible for rule tweaking in some kind of overall sense, it would be helpful. Like if you like. One of my favorite people in your fine town, although I guess he lives in New York, is Paul Volcker. And a person like that has got this overall sense of how this needs to work, how it should work, and what's just silly. So, and when Paul's got the stature when he says this is just silly, people sort of say, he kind of knows what he's talking about. So yeah, I think we have it very fragmented. And sort of, on one hand, all the agencies are fragmented, and then Congress is into the big, all singing, all dancing, one-time fixes, and that combination hasn't worked. I mean, I think we can just definitively say, with two monumental blowout crashes in a 7-year period, it's not working.
And let's just go global for a moment. Your country and Europe. Speak to how they're doing on this issue of tweaking rules versus trying to solve everything.
Well, in Canada, I would not say sort of Canada's got it all figured out and all fixed. But that having been said, it did not crash nearly as bad. We didn't have a single bank bailout. No bank even got into modestly difficult, or insurance company into modestly difficult trouble.
And we have a hero in this case.
Yes,
right?
we do. We do. I have this.
A woman.
A
So
woman.
I always think we just need more women at the top ranks in Wall Street, and that'll.
I'd go for that in a second. A little less testosterone wouldn't hurt. Julie Dixon, who's got this sort of really boring sounding job as a superintendent of financial institutions, and the approach there is one more of just sort of consultation and the odd sort of smackdown. And so Julie Dixon comes to Toronto. She's up in Ottawa. Comes to Toronto on a routine basis and just meets with the bank presidents and chairs. We have one in the room here who would know this, and just will tell them, this is silly. Stop that. Don't do this. And pretty much they have to listen. I mean, they don't by law. They could do what I think of as a little more American thing, which is, hey, yeah, handcuff me and take me downtown if I'm breaking the law. But in her case, there's more of a, this is a dumb idea, stop it, and there's more of a willingness to do that. And I think that kind of sort of tweaking and a principle-based rather than a purely rule-based kind of regimen is what we need.
And let's end on that note, principle-based. Just describe what the principles would be.
Well, I think principles for the capital markets would be some things that I think we have, which is transparency, but also I think we now have a principle which says that trading value is super important and maybe the most important thing, as opposed to building value. Hedge fund managers are going to soon be the number 1 way to get on the Fortune or the Forbes 400 list of richest Americans. Sorry, it's Forbes. But high tech has only a modest lead now over hedge fund managers who've come up from almost zero 10 years ago to the 2nd greatest number of people on the Forbes list of the richest Americans. If we have a principle that says trading value, creating no net value, just trading value between people is as important or more important than building value, then I think we've got a messed up economic system.
Well, on that note, I want to thank you. You've been terrific.
Thank you.